Global investors are going risk off in the wake of escalating trade tensions and weak economic data. U.S. stocks taking the brunt of the pain as the shift threatens 16 years of U.S. stock dominance. So far this year, international stocks outperforming the S&P 500. So how can investors take advantage? For more, we've got Omar Aguilar, Schwab Asset Management CEO and Chief Investment Officer. And Omar, it's great to speak with you. Obviously, this comes in the context of over a decade of the U.S. outperforming all these other indices. I consistently have people say we're finally going to see a year where there is opportunity abroad when it comes to stock performance. Should investors be repositioning now to take advantage of potential gains to come, specifically in Europe?
Yes, good morning. Thanks for having me. We have been discussing this, for the last, I would probably say 6 to 8 months, as we're going into the dominance of the U.S. for more than a decade and the need for diversification, and particularly because the concentration that we have seen in the U.S. in the Mag 7 for the last, 2 years, started to rotate, at the end of last year. What is interesting when you look at today, the Mag 7, that we discussed, a lot last year is now focused concentration on the new Mag 7, as our strategists call it, which is the defense companies in Europe. When you look at the performance of those companies relative to the rest of the market, that has significant, changed the dynamics. To answer specifically your question, yes, valuations is still in favor of international stocks. We still see the possibility for a weakness in the dollar as we actually see changes in monetary policy, and that usually provides a significant amount of tailwind for investing internationally.
Omar, let's talk about the Treasury market. Yields have been falling. 10-year yields hit their lowest level since December recently. How does that impact your thoughts on portfolio allocation?
Well, the situation with fixed income, this year is been one of those where every week is a new week. And the volatility we have seen in bond yields is something that it probably doesn't have the level of precedent. If you remember not too long ago, the 10-year yield was approaching 5%, now is getting close to 4%. So that range and changes in volatility just provides a lot of the outcome because, the sources and the drivers of yields is being very different. From the beginning of the year, the changes in yields and the rising in yields at the beginning of the year was mostly as a result of expectations on inflation. And then when you actually see the drop in yields now, it is really more as a concern about growth. So when you think about the why is driving and what is pulling these yields in the fixed income market, clearly you have to put into context that the concern of investors right now is really more about, what the current tariff, potential could have in long-term economic growth. And that is what pushing the yields down, as opposed to what it was at the beginning of the year, which was more, the sustained sticky inflation that people expected.
And I wonder, too, how that plays into how investors can play the volatility of this moment. We were speaking with Mohammed Al-Arian, Queen's College, Cambridge president, last hour about the two biggest concerns that he has for markets right now off the back of all of this policy uncertainty from the Trump administration. Let's take a listen.
There are two concerns in the marketplace. One is that this unpredictability is not short-term, it's not a bug, but it's a feature. And two, that the tariffs are not cyclical, but they are secular. Those are the two main concerns. And if they were to play out, then the outlook for 2026 would be less cheerful, if you like.
So, Omar, if the volatility that we're seeing right now and the policy uncertainty from the Trump administration is a feature and not a bug, what is the single best way for investors to play that volatility?
Yeah, there's two pieces that we continue to talk to our clients, at this moment. Number one is uncertainty will stay with us for the foreseeable future. There's still going to be significant amount levels of volatility because of the uncertainty that we are experiencing already and what we expect these, to play out. And I think a big part of the discussion is, how much of this volatility is short-term versus long-term. And when you think about the short-term, it is really more concerned about, how you position your portfolio, and it's more about de-risking and reduce risk in your positions as opposed to what will change in your long-term expectations expectations of economic growth and potentially of the expectations you have on asset class performance. And I think when you combine those two, the short term, where you actually have, there's no reason to take additional risk at the moment, but at the same time, take the opportunity, as we discussed, if you didn't have enough international stocks, this is an opportunity for you to rebalance your strategy and go and invest internationally. If you think about, short term versus, medium term, maturities and duration in your fixed income portfolio, this is the right time to just rebalance those pieces to make sure that you're prepared for the next wave of uncertainty. Volatility usually provides opportunity for investors to rebalance their strategy and stay within their risk profile. What I think is more important is to understand that, the biggest, uncertainty right now, it is, what will be the long-lasting economic impact of potential changes in this uncertainty. In other words, consumer spending, consumer drivers of GDP, as well as the potential earnings, impact may drive a lot of what these volatility may be in the next few months.
Omar, you pointed to European defense stocks being one of the major beneficiaries of capital flowing back into international stocks. How much do you think we can expect to see more capital flowing into the Ukraine reconstruction thesis? If we do see peace coming about in Ukraine, how do we see perhaps construction firms and other kinds of European sort of builders benefiting perhaps from, a change in the geopolitical stability of the region?
Well, historically, geopolitical events, have a short-term increase in uncertainty and volatility that obviously needs to navigate. But in the medium to longer term, usually provides, economic incentives because of government spending and because of capital flow. So usually when you put all those things in perspective, whether it's reconstruction, whether it's industrial companies, whether it's, defense, companies, they usually tend to, benefit when you have, that path towards a change in geopolitical landscape. It's not very clear, what the timing is and how does that work. But as investors prepare for what may come ahead, it is very clear that with the changes in the landscape and what we may expect, over the next few years, precision, portfolios to take advantage of economic recovery in areas that have been most affected by geopolitical events is usually a strategy that has worked, historically.
All right, Omar, we got to leave it there. Thank you so much for joining us. We appreciate it.
Thank you.